H is asking, within the last year, it appears you guys amended your GIP asset allocation worksheet to include tech as an equity sector overweight. What precipitated this change? I think they're talking about slide 8. So if you go to slide 8, so what we're showing there are the sectoral asset class, sectoral, style factor, fixed income sector overweights and underweights per quad.
Yep.
I think what happened with quad 3 is that equity or tech, which has always been an overweight in quad 3 based on the data, it's probably creeped up higher just given its recent outperformance over the past few years in the iterations of quad 3.
Yeah, well, it's quad 3 in tech. Don't forget that quad 3 was tech when it was in the the acceleration phase, even when the economy slowed in 2016. I can't say this more than I've said it multiple times, but I'll say it again. Consumer discretionary and tech both did well when the shit hit the fan in 2016. It also has done well actually since the financial crisis because there actually has been an organic story that was discounting the peak of the U.S. economic cycle, peak of the U.S. profit cycle, which was perpetuated by tax reform, and just basically peak of inflation too. So that's why tech is an overweight in everything. Slide 93 didn't come out of nowhere. Where look at software as a percentage of the S&P 500. So that's just all born out of performance. So what happens on slide 8 is this: it's not like there's a survivorship bias only to a degree. And then when you start to see things perform over a more pervasive period of time, then those things will start to backtest better. That also gives you some pretty dangerous spots. Like right now, I think that the most dangerous thing about tech being in quad 3 on the backtest is that software is breaking down on a trending basis with tough comps. So again, that's actually the playbook within the playbook. So again, this is a guideline. You don't just like say, well, this is how you train a dog, and just don't worry if it bites your kid in the head. It's okay. It's like you gotta understand that things start to happen within the conditions that you're and the parameters that you're looking at, and also within the framework. So again, you don't just do that specifically. You have to then start to do your work actually, and that's the whole point that we're trying to make sure that you see of the software cycle slowing against tougher comparisons when people think they should buy tech in any quad other than quad 4.
And we've been making that call since the end of August that if you're going to be long tech into this quad 3 transition or potential quad 2, whatever you want to call it, the jury's still out on that discussion specifically, but if you be long the other parts of tech, there's semis, there's hardware. You don't have to be long everyone's favorite secular grower, especially when they're imploding.
Yeah.
That's the whole point of risk management. All right, H is, oh, and by the way, we do, just as a point of reference, we had this conversation on a call yesterday as well. This slide changes. Like the back tests are live. They keep updating every quarter. So if you look at this slide from a year ago, you missed 4 quarters of new information.
What is the macro show? What are we pricing macro show at right now?
I have no idea what it would be.
40 bucks?
Yeah.
You don't mean you can just subscribe to the macro show for 1 month and get the playbook for life and static?
Static.
Like the old wall model?
Using last year's price data and GDP data.
That's the whole point of a fractal pattern, which is life. Again, the data changes. It's dynamic, nonlinear, ever changing. That's why the back tests change, because again, the price movement changes. You get that. I know you get that. But think about like how all these people on Wall Street, asset allocation folk, they've capitalized on your stupidities to a large degree. Maybe not you guys, obviously, but the stupidity of the population by basically saying that statically, all you have to do for your asset allocation is this. You just have to go like this and go 60, 40. Bonds and stocks. That's asset allocation. Now, come on. Seriously. I mean, pre-internet, I could see where these things all came from. But come on.